Welcome, everyone. I see that folks are starting to join our breakout room. As folks trickle in, I'm going to kick us off. It's very exciting to have such a global audience at the GIN's inaugural Next Normal Now virtual event. I'd like to remind everyone that this is a public event and the conversation today will be on record. And there may also be journalists in the room. For those of you that were able to join the opening remarks, as Sapna mentioned a moment ago, attendees can check out different breakouts. And we do encourage that as the purpose of these breakouts for you all to access as much practical relevant information as you can. As Amit and Darren mentioned just now, we are here to talk about bold but practical ideas. We're also here to talk about with a mindset of abundance, interdependence, and interconnectedness, and how all you as investors can play a role in a world that is sustainable and inclusive for all. The topic of this breakout room that you're joining now is financing a green transition. My name is Kelly McCarthy, and I am director at the GIN. As the moderator of this conversation, I invite our speakers to share concrete and innovative examples of how their organizations are practicing the next normal, but in the here and now. My role is to stand in your shoes as our audience, ask questions, hard questions that you may have been thinking, and also field questions directly from you. I'm joined by two colleagues today who will help make sure that the session will run smoothly. Liam Morgan is our tech lead, and you can reach out to Liam if you need to troubleshoot any technical issues. Grace Earl is our questions lead, and she will be doing the intake of audience questions. You can feel free to send questions directly to her from the top of this conversation to the bottom, and she will help make sure that those get to us and the panelists. In terms of format, we'll spend the first half of this session listening to remarks from our speakers, and then the second half is reserved for Q&A directly from you. Just a few housekeeping items. Before we start and introduce our speakers, I want to cover a few technical details about the Zoom breakout room and the logistics of how you can connect with your fellow attendees. All of you are joining currently on mute and in video only mode. So you will not be able to speak, but you will be able to chat. And you'll see at the bottom left-hand side of your screen a chat box that you can use to introduce yourselves and your fellow attendees for general comments. By now, the chances are that many of you have been on many video calls and you're already familiar with the chat function, but just as a refresher, in the chat box at the bottom of your screen, you can enter your messages. There's a little scroll tab. The default setting will be everyone. You'll see a word that says everyone, which means that your chat message will go to everyone. You can use that to share resources like links that are relevant to reports, or the URL of a mission-aligned organization that you want to share with everyone. I'd love for all of you to interact and engage with each other in this way. We also will be collecting questions for the three speakers, as I mentioned, and these questions must be submitted to the questions lead co-host. So you'll see that on the screen, Grace Earl, GIN questions lead co-host. Please do not submit that to everyone or to myself or the speakers because we will not see them. You can send your questions to that question lead by going into the little scroll tab and just chatting it directly to her. If you experience any tech issues and need assistance, you can reach out to this session's tech lead, Liam, also via the chat, who will be able to assist you further. The tech lead will also share all of these guidelines, again, now in the chat box. And now on to our session. So today, I'm really hoping we can have a conversation, a practical one where we're reflecting on real examples, experiences, and solutions. I'm really hoping that you all get to know our speakers get to know each other, and that we walk away with something very practical that we can take away with us in our day-to-day lives. So we're here to talk about transitioning to a green, financing a green transition, and to achieve the global ambitions for such a transition, I believe, as we all know, large sums of finance are needed. For example, by most estimates, in order to limit the temperature rise to 1.5 degrees Celsius, the International Renewable Energy Agency estimates that global annual investments in renewable energy have to double from what they are today towards 2030. Until recently, green investments were considered both alternative and high risk. However, over the course of the last decade or so, more than euro 2.28 trillion or USD 2.7 trillion went into building new renewable capacity globally, primarily solar and wind energy. So financing the green transition is one of the largest global challenges and investment opportunities for the coming decades. So this session will feature practical examples of investments that can help us achieve these goals and other sustainable and green financing goals. The speakers we have here today are leaders, and their experiences and insights are meant to serve as an inspiration for everyone involved in supporting a transition to a green economy. Diversity is very important to us at the GIN and to addressing the challenges for the benefit of all. We are incredibly grateful to have speakers with us today from around the world who will be speaking about their innovations in their own local context, but that are relevant to all of us. So with that, I'm going to introduce the speakers to our session. First, we have Saskia Werther. She manages the Circular Entrepreneurship and Sustainable Energy programs at the DOEN Foundation and has been with the foundation since 2014. Prior to joining DOEN, Saskia has worked in the social enterprise and impact investing sector in South and Southeast Asia. Saskia started her career in banking at ABN AMRO in the Netherlands and in the Caribbean. We also have Grace Wee, who is the head of Green and Sustainable Finance at Hong Kong Exchanges and Clearing Limited, with the responsibility for the development of HKEX's Green and Sustainable Financing Program. Ms. Wee is an honorary advisor to a member of the Inspection Committee for the Financial Reporting Council, a member of both the Regulatory Oversight Board and the Sustainability Committee of the Hong Kong Institute of Certified Public Accountants, and co-chairs the Market Development Workstream and the Carbon Market Working Group of the Green and Sustainable Finance Cross-Agency Steering Group, established by Hong Kong Monetary Authority and Securities and Futures Commission. And finally, we have Stephan Morency. He's the Chief Investment Officer for Fondaction, a pension fund in Quebec. Stephan brings more than 25 years of experience as a private fund manager and strategic advisor. His unique experience is influenced by his skills in finance, business, and entrepreneurship, and he is known for his creation of specialized funds, notably with the creation of Inlandsis. All right, so with that, let's get started. The topic of this breakout is financing a green transition. So I'm going to turn it to my speakers. What does this mean for your organization and the work that you do? Saskia, I'm going to start with you. Will you tell us a bit about the innovative approach that you take to build a more sustainable and green economy? And specifically in your role at the DOEN Foundation, you focus on early stage investing in the circular economy. Can you give us an example of a standout company and how they are an innovation to watch?
Yeah, thank you. And thank you for having me and organizing this event, very important in these times. So I'm a program manager at DOEN, and we fund very early stage. So mainly social enterprises when they've just started. So it's really catalytic capital, high risk, and we can do everything from grants to direct investments and everything in between. And we do this with funds from charity lotteries here in the Netherlands. And I have one example I wanted to talk about, which is in circular economy, which I think is one of the topics that is and should be part of this green transition. And that's in a company called the HKEX, which is also a translation kind of leftovers in Dutch. And what they do, basically they're in waste management, and they want to combat wasting valuable urban resources, mainly working with restaurants, but also with shops in urban areas that when their waste is collected, it's basically collected in everything together, which also means that organic waste is often destroyed, whereas it can be it still has a lot of value. So what they do is they work with customers, with restaurants, for instance, to segregate the waste. They pick it up, CO2 neutral, they do it. they collect it at their hub and they use it as resources to actually create new products. So for instance, coffee grounds, they use it to actually grow mushrooms. And what they want to do is then sell back these mushrooms to the restaurants. So they close the loop with it, with actually that one restaurant. So that's what they do. So they started in 2019, and that's also when we funded them for the first time. So really early on, I think they probably had 10 customers then. They have around 60 now. And why I think it's an example of how we could fund, it's because it's early stage, it's risky, but for us, the potential of impact is quite important. So how we funded them is with a hybrid between a grant and an investment, whereas we took the risk early on because of the impact potential. We think if it goes wrong, it's okay if we use the grant, but if there's an upside and if they do really well, which we hope and I think they will do actually, then we can turn it into an investment. So that's a way for us to structure our type of funding with the impact central to it. So a couple of reasons why we think it's an interesting organization to fund is that they're active in the circular economy, that they're looking at a systemic approach for impact. So really changing the system, changing their customers and their behavior as well. But also how they look at impact and how they look at scaling. So for instance, they've just closed an investment round and they changed their governance structure during this investment round, that they went from to a steward-owned model, which means that decisions for the company, important decisions, will be made by stewards outside of the management. This will also mean that if they scale, and there will be decisions made on impact, that the stewards have the final say. So it's really a way to safeguard impact. And that, to me, is how we should hopefully structure investments for the future to get to this more green and inclusive society, like you mentioned.
Fantastic. Thank you, Saskia. And we will come back to this. So this stewardship model as an example of a way to help companies maintain their mission and transition in a really solid way towards scale. So that's fantastic. Grace, I'm going to turn to you. In your role at HKEX, you have an opportunity to help incentivize and support companies to kind of take that next step, to transition to green finance and scale. And specifically, your focus is looking at taking that with a net zero approach. Can you walk us through an example of one of these companies and an example of this sort of incentive and influence model and your role really in supporting this transition and the impact it's having in Hong Kong?
Thank you so much, Kelly, and I'm so happy to be here, and thank you to Jin for inviting me. I would like to just share with you that HKEX is the only stock exchange in Hong Kong, and we are very closely connected to China, as some of you may appreciate. China has pledged to become carbon neutral by 2060, and given Hong Kong has an economy with very little manufacturing and agriculture, our goal to decarbonize by 80% by 2050 is actually quite ambitious. So we will look at the building sector and the transportation sector. Today's example, I'm going to talk about a property developer because building sector in Hong Kong accounts for more than 60% of our greenhouse gas emissions. And therefore, reducing energy consumption in buildings is very critical for us in Hong Kong. And the example is New World Development. It is one of the top blue chip property developers in Hong Kong. And it has buildings in Hong Kong as well as Greater China. Now, they have been doing green finance for quite a long time. And recently, they have become the first property developer to set a net zero target by 2050. For us, given the exchange is both the market regulator and market operator, it sets a very good example to other property developers in Hong Kong and in China of seeing the pathway to net zero. So to begin with, New World Development has been issuing green bonds and green loans to finance the green buildings in China as well as Hong Kong. They have so far raised over 5 billion Hong Kong dollars in green loans, as well as 200, I would say, actually doing the translation, 310 million green bonds in order to fund some of the developments in China. And all these green buildings, I think what's important is that they have achieved international recognized certifications to get that green standard, if you like. And most recently, they have become the very first world developer in the real estate sector to raise a sustainability-linked bonds. That means they want to achieve better targets in terms of in areas other than just simply environmental. So I think this is a good example, given that all the green bonds and sustainability bonds have been oversubscribed. There's a lot of demand by investors in this region for this kind of financing, and they set a very good example for other developers in Hong Kong and China. Thank you.
That's incredible. And so we're sort of taking a journey through scale here, right? I'm going to turn it now over to Stephan, over to you. So you figured out a way to sort of so thinking about this, buy up long-term return by taking energy efficiency related risks off the table. And so thinking about scale and growth from that perspective. And this is the potential to scale energy efficiency to the next level globally. Can you tell us a little bit more about that as well?
Yeah, so what we're talking about is one of our initiatives that we launched last year. It's an energy efficiency fund, 150 million in size. It acts as a pilot before we scale. We named it SOFIAC. It's operated here in Montreal, Canada. Why I think it's a great innovation. It actually is a financial instrument that uses blended finance. So it's a partnership with the government, and it's about to become like a norm in energy efficiency. I'll talk about it later, but I think in the 5 next years, we'll see these funds and exactly that kind of recipe applied to other jurisdiction. Why it started in Montreal, like in our part of the world, energy transition is really focuses on energy efficiency because we produces hydroelectricity in abundance. So we have all these green electrons in abundance. And what happens when you have something in abundance? You just waste it. So the impact here potential is about like every time we save 1 green electron, we actually export it to the US where there's a lot of brown electrons to be replaced. So here's why it's important on the impact basis. So the government and the agencies for the past couple of years have tried to crack that nut, and unless it's heavily subsidized, it's never a priority for the promoters. And we got kind of dive 7 years ago into it, trying to understand what's happening there, why it's not a priority, because it's actually, it drives a profit, it drives a return. But the thing is, the risk perceived by the promoters related to energy efficiency project is perceived as being very high, and the return is too long-term, like the payback is too long-term for them. So, and on the risk side, you're talking like technical risk. It's like feasibility risk, implementation risk, the performance risk. Is it actually going to drive my cost down in energy? And all that, I need to have that on my balance sheet. So there's the financial risk to it. See, it's tens of millions of dollars sometimes, these projects. So on the payback time, which is really weird, is that they're looking for paybacks within 2 years. But when you look at it as a financier, it's like a 10, 15 years annuity that drives a 10% return. So there's an arbitrage there. So we were looking at it as a financial player, we want these types of returns. And as an impact investors, we want to drive this impact. So we had to crack that nut. So what's the innovation? Like, to make it 7 years of product development story short, we kind of figure out a way to buy long-term returns by internalizing all these risks within the fund. So the inspiration was pretty much like what you can see in Renewable Energy Income Trust. So the fund builds, owns, and operates energy efficiency projects, but instead of having a stream of revenue for selling the energy, we're actually getting a stream of revenue from energy savings. But it's kind of the same solution, same thing. So we eliminate all the major barriers. The technical assistance is in-house and subsidized by the government, but we operate it so that we can drive new projects. The second thing is the implementation responsibility is on the fund. So we contract with the actual engineering firms. We contract with them and we monitor it. The third is the performance risk, and that's kind of the key to it. If there's no savings, we don't make money. If there's savings, from day one, we give them 20% of the savings and keep 80% of the savings. And finally, the financing is 100% made by the fund, so no cash by the promoters. So when we kind of started presenting that, it was kind of too good to be true for the promoters, but it unlocked tons of projects that were deemed non-feasible before, hence the impact actually. So why we think it's a model for the future is that since we launched that like a year ago, we've had unsolicited contacts by other governments in Canada wanted to roll out this model throughout Canada. We've had major asset managers in Europe, country by country, going like, we'd like to see that happening in France, in England. So we think that we kind of cracked with innovation by partnering with technical people, because the interesting thing is that in that fund, you have the technical and financial expertise all in one place. So I think this is why we think that has a potential to scale the energy efficiency to the next level. And I'm here to kind of answer all your questions and generosity. So thank you for having me.
Great. And the questions are pouring in. I'm going to put one to all three of you because we're getting several questions about when you think about your particular example, there's potentially a financing gap on one side or the other to get to this stage that you're actually engaging with, you know, in this particular fund or these particular company examples. So folks are really interested in hearing what in your mind, in your experiences, what measures should be taken to bridge those financing gaps to help these types of companies kind of move through and expand their impact. Let's just go round in the order that we started. Saskia, can I kick off with you?
Yeah, sure. Yeah, I think in this, at least for the enterprises we support, it's usually the risk appetite is a big thing. So it's very early stage, and often there's a lot of investors who would say, oh, come back when there's a bit more traction. And of course, it's very logical in terms of everyone has their own mandate, right? And that's what we always try to do at all the impact investing conferences, see how we can build on each other. So that, for instance, organizations like us can come in first, but still, I think there's initiatives on how we can work better together, but it seems, I think we can do a better job at that, to see if we can understand each other's mandate a bit more, and also how we kind of build investments on top of each other. I would say a bit more layering in a sense.
Great. And Grace, yes, in your experience, thank you.
For us, I think with all the countries setting a carbon neutrality goal, what does that mean? You know, we all have to do something to get there. Because climate risk is something that is irreversible, as we all know. So I think for companies, I think first and foremost, they must disclose measurable, comparable, and credible ESG data. And secondly, is to set a science-based target to get to net zero and have a plan to get there. Now, having a plan, it's good because you need to look at your business operations. You need to look at how you are using your energy, for example, and whether you need to have a different type of infrastructure, whether you need to electrify your operations. So all of these things, you may need funding. And there are a number of investors, especially in this region in Asia, looking for green and sustainable investments. We have, one of the most, wealthy, individuals and family offices in Asia. And a lot of the millennials are looking for green and sustainable investments. They are driving the change here. And so I think for companies that are willing to take this bold step to have a commitment to science-based target and to support the carbon neutrality goal, you will find that investors will come and support your long-term goal as well.
Fantastic. And Stephan, before we turn to you, I am noting a lot of questions. We'll come back to this about the role of disclosure and data in helping sort of sort this whole transition out. So Stephan, over to you.
I think that before there's green finance, there's got to be greening finance. And the thing is, we're dealing with new problems, and the expertise is in the field. It's actually being technical, and it hasn't reached finance yet. So finance doesn't understand. So the way to do it is actually for us impact investor to tackle problems and joint venture with people in the field, with expertise in the field, so we can co-design solutions that are tailor-made for that. Once you've proven it and you have a track record for return, then it becomes available for green finance and scalability. But our role is the greening finance is really to prove the model, and the product development is really, really important. The problem is it costs you. This thing's been 7 years in the making, so it costs you. So it's important to actually partner up, find development platforms we can all collaborate to diminish the cost of these product development.
Great. And I mean, and you're hitting on, a couple of points that, folks are really keen to hear from you all on. You're talking about track record, Stephan, and improving the model. And Saskia, you talked a little bit about the proof points as well. And obviously, Grace, you have a lot of experience with how disclosure drives change. I'm going to start with you, Grace, on this one. But again, folks want to hear from each of you on just thinking about the role of actually measurement and data and information to help drive those decisions and grow those companies. So Grace, over to you.
Thank you. As a market regulator, we have more than 2,500 companies listed on our exchange, from global conglomerate to very small companies. Over the last 7 years, we have set a reporting guideline in terms of ESG. Every listed company on our exchange has to publish an ESG report every year. And the latest listing rule amendment is to require the board's involvement. They have to take the responsibility of setting the ESG strategy for the company and incorporate that into their overall corporate strategy. We do not want ESG reporting to be a tick the box exercise, to be a compliance exercise. We want the board to be involved to look at the risks and opportunities arising from ESG, and to do so, you need to do a lot more stakeholder engagement to see where you can improve in terms of where you are in the environmental and social aspirations. And so I think that from that perspective, disclosure is getting there for companies listed on the stock exchange. And we are also moving towards a standardized disclosure in the sense that we are supportive of what the IFRS Foundation trustees are doing in harmonizing the different standards and frameworks out there in terms of reporting, because it's very hard for investors to compare apples with oranges if everybody is using different frameworks and standards to disclose. So first and foremost, we in Hong Kong, we have already declared, same as London and New Zealand, that we will adopt the Task Force for Climate-Related Financial Disclosures disclosure framework. And for all relevant sectors, it will be mandatory by 2025. So hopefully, in addressing climate change, in setting target, you will see that we will move a leap frog forward, if you like, from that perspective. So I think that was going to really move the dial. Thank you.
Thanks, Grace. And Stephan, I'm going to come right back to you to talk a little bit about your point that you surfaced at the end of your comment in terms of track record and kind of proving the model. Can you talk a little bit about your use of or experience with understanding impact in this particular example?
Yeah, we're at the stage in institutional finance. We're at the stage where people want both together. They want the impact and the return. So just the impact, it's going to be for family office and foundations and stuff. But in my world, they want both of them at the same time. So it works kind of the same as it used to when we were creating a fund. A first-time fund needs a track record. They need to prove that they can drive return. And it's very hard to do, actually. The second thing is, if you apply that to extra financials, so to impact, you need to exactly have the same thing. And hence the Iris Plus catalog and these things, because you can actually compare with others, as to your point, Grace. But what's interesting, I think, in terms of the track record and how we position ourselves is we act as an incubator for these first-time funds. So we lend that legitimacy, the credibility, because we're like billions under management, and we find these guys and girls that actually has solution, and we incubate them, lend them the credibility so they can actually, instead of taking 5 years to raise a fund, can do it in 6 months. Because actually we're trying to fight climate change, and it's not for 5 years, it's like next year. So this is how you can actually accelerate the track record by being an impact investor with credibility.
Great. And Saskia, if you can build on that a little bit, but I also know, just kind of connecting the dots from Grace's comments, the EU is also, looking very closely at the taxonomy, EU taxonomy work, and green finance classifications. So how does that all sort of play into, track record, demonstrating impact, especially for these early stage companies who are really, they're really in that proof point stage? How does that play out for you?
Yeah, well, this actually, and also what Stephan mentioned on actually working with the guys in the field, right? And actually that it is pioneering on all levels, made me think of what the clique is actually going through now in terms of impact measurement, right? If it's about track record and seeing what you do, they have to prove their impact as well. But now, because they're in circular economy, which is of course fairly new as well, it's quite hard for them to actually think, how do we measure our impact? Because there is a lot out there and on higher levels as well. But for them, it now comes to, okay, if I collect waste from this restaurant, how much, and I collect it, I make new products out of this, how much am I saving and what's my actually contribution in this? So then it's still actually quite a puzzle to be really thorough about this impact measurement. And I'm actually now thinking of that these worlds are still, especially at least for these pioneers, they're not so connected, right? And to Grace's point, her comment earlier as well about data monitoring, etc., that we should actually disclose these best practices much more so that they're more publicly available on all levels, from the pioneers who do it, then building funds on top of that, just to make it easier. Because as well, to Stephan's point, we have to do it now, right? We don't have like 10 years to develop this whole taxonomy and to make it work, but we have to do it now.
Fantastic. So I want to sort of pivot just a little bit, but I want to hold this concept of proof points, disclosure, driving change, because I think, as all of you've highlighted, this is really a glimmer of the future. That although, Grace, in your point, there's still voluntary versus mandatory, but the sort of shift is happening right now. So I want to make sure to hold that and think about that in your comments. There's a bunch of specific questions for each of you. I'm gonna actually go back to Grace right now, and there's a question actually about your example specifically around green buildings, and some folks are curious about tapping into different types of capital to help who are keen to invest in the green building sector. There's just some questions around sort of the role of family offices, or the role of, again, different types of capital kind of playing a role in financing that transition. And so we're curious to hear from you what you thought on that front.
Yes, thank you very much for the question. And we have a lot of family offices recently set up here in Hong Kong, partly because I think the wealth managers such as UBS and others have already pledged that if all things being equal, they would advise their clients to buy products that are sustainable and green. And so there is a huge demand in terms of sustainable investment products. Now, in Hong Kong, we currently have bonds and ETPs, and clearly we have 2,500 companies. A lot of them have been rated by different benchmark providers. So in terms of finding family offices that are looking for green buildings and vice versa, we have the Family Office Association. We have the private wealth associations that you can tap to. But do come to Stage, which is a platform that I launched in December last year, and it is meant to be a platform for efficacy, for collaboration. And in that Stage platform of HKEX, you will see a lot of information for investors, such as all the green bonds and social bonds and what have you that are listed on the exchange. If you want to find out the use of proceeds every year from the investments, and to see the environmental impact or societal impact, you will see the information on our Sustainable and Green Exchange, the Stage platform. The reason why we have invited issuers to join Stage, and it's for free, is that we want to showcase the good that they are doing. And to basically allow there to be more secondary trading of these products, and to give the comfort to investors that the greenwashing isn't really there, and they can see for themselves because these reports are certified.
Great, that's super helpful. And this is a great segue to a question for you, Stephan. Specifically, so on this topic of greenwashing, again, on this topic of the use of information and proof points. Question for you in terms of how you recommend the companies within the fund's portfolio disclose or estimate, whatever tools that you're looking at, their CO2 footprint, emissions. What are you using for that particular piece of the pie, assuming that's something that obviously goes into the equation around your energy efficiency example?
Yeah, but our reality is more like Saskia. It's like private companies, and these people are always short on staff. Actually, they're trying to build a business, whether it's like a startup or even a company that has 20 million in revenue. They don't have infinite resources for that. So we actually take on all of that internally. We've built a team internally at the fund that we call Global Performance, actually brings all these measurements and that expertise within our companies so that we can help them get that information out, or else they would actually deal with someone else, because we already asked them a lot of information, a lot of financial information, everything. And there's a lot of people out there not asking for one of these data points, nothing. So during the due diligence, we're being, I would say, like, proving it's going to be for them and their service, and we're going to have the people implementing that into their companies. So, and this is how we get it, and we don't impose upon them. You have to make a report. We'll take care of it for you, but then we'll share the information with you so you can actually drive more impact. But we'll bring the intelligence, or else I'll tell you, they'll go elsewhere.
Interesting. We'll have to connect these experiences in a minute. Saskia, again, building on this, folks are interested in understanding a little bit more about, sort of the circular economy concept and how those that are interested in relating to the idea of like a cradle to cradle, a circular economy, a zero waste as a fundamental principle of their actual model. When you look at companies like the one that you gave an example of, is there any lessons to extract there for others that are trying to consider that same kind of goal or aspiration? Does that question make sense?
Yeah, it does make sense. I'm just like cracking my brains now. Well, we started on, I guess, this supporting circular enterprises, I think 4 years ago now. And initially we said we will only support 100% fully circular business models. They're not really there yet. And that's also because we still live in a linear economy. So what we do, at least, is look at if a company or if the entrepreneur or the entrepreneur's management team, whoever, really has this circular vision and this mission, and that they're really trying to achieve it. That you're not achieving it from day one can be okay, as long as they have the vision to actually make it. And for us, for instance, it's also important, well, this whole point about transitions, that is, of course, the theme of today, but that's also how we look at it, really looking at it, systemic change. So for instance, in the example of the clique, for us, it's important that they're trying to close the loop, but also that they're working on this more behavioral change part on the customers they work with, so that they are inspired to work in a more circular way as well. Because it is, I think, it's great to have the ambition to fund 100% circular, but we have to realize that we're in this transition, right? That we're working on systemic change. So to keep in mind how the organization, the enterprise or the fund that you want to support is actually helping to achieve that systemic change, I would say that's important, and that could be a lesson to take into account.
Right. So I'm going to come back to, there's an interesting sort of point that's being sort of danced around here, around the drivers of disclosing certain types of information and some of the risks with asking for too much. Stephan, you kind of alluded to this, and what strikes me is that we're in an interesting phase. And Saskia, you really hit the nail on the head when you said this is all about transitions. We're in this interesting phase right now where, you can see clearly, all three of you are talking about, you can see the need for impact to be an actual factor alongside financial information. But we're not quite there in terms of all companies, all funds being capable of providing that kind of information as regular business. I'd love to talk with all of you. We'd love to hear from all of you how you're dealing with that. And I know, Grace, it sounds like you're a little bit further along in that journey just by the very virtue of where you sit. So I'm gonna end with you actually, but I want to kind of come back to this point. Like, how are you actually dealing with that transition? How do you see what you're doing, sort of nudging along so that you're continuing to kind of meet the market where it needs to be? And Stephan, I'll start with you. I saw you go off of mute. Okay.
We're really interested in measurements, but we're more interested in impacts. So for us, like, measurement is the consequence of impact. It's actually like to make sure that impact is there. So I think the the way we kind of see it is we refer to a time in the world where people were able to make investment thinking it has a role to play socially, environmentally. And we forgot about that. Like in the 80s, we just went finance for finance, and finance is kind of a god, doesn't need anything else, and no link with society. So the measurement thing for us is kind of education. It's like bring back these factors in so that these companies rethink their relationship to the world, because they say, like, when I do this, there's this. When I do this, there's this. There's positive, there's negative, there's. So at one point, we were using that more internally with our own people than externally, because the first people that need to kind of understand impact are the investors, are my people, the young account managers and stuff, looking at a company and going like, I see impact in this company. This is what drives the transition. Now, technocracy behind the scene can actually translate their intention into all these measurements. But where I'm a little worried is sometimes I hear the technocrats taking all the conversation, forgetting the intention and the impact. So I think we kind of need to rebalance that, or be kind of aware it could derail if we just talk about the numbers and the data and the measurements. We're going to lose intentions and impacts, because the entrepreneurs are talking intention and impact. They have a vision. They don't have a technocrat plan.
Great. And so from your perspective, this is really about the impacts leading, the sort of like dichotomy between the heart and the mind, or the heart and the head, I guess. The data not being so obtuse that we lose the actual story behind it. Saskia, can I turn over to you again? How are you kind of riding this tension between where we are today, but where you see impact as a factor driving investment decisions in that transition going?
It's a bit different for us, because for us it's always the reason why we invest, right? And I guess the financial returns are secondary for us. But I would build on Stephan's kind of why do we need it and the impact, etc. For us, we only fund kind of impact first enterprises or funds. They need to understand how they're making impact, what they're achieving, because that's their strategy. They need to make it better, then they can maximize the impact. And then it's kind of like this, it becomes this virtuous cycle. And I was thinking more, again, on the resource constraint, that it is quite hard when you're building a business and you just started to also, measure the impacts perfectly. So what we then also try to do, well, I wish we could do what Stephan had and had a whole department for it, but at least we try to help them with asking the right questions, and also to see if sometimes we can provide additional support that they could do impact measurement, etc., to understand it.
Thank you. And Grace, the last word is yours on this one. Do you see it differently, the same?
Yes, I see it the same. I think at the end of the day, it's about giving investors the confidence of seeing the impact, right? I think, the most important thing for us to develop this platform, information platform for investors and issuers, is that, how can we drive more resources towards the goals of SDG? How can we make sure that they're going where they're needed most, and are they being used in the most effective way? I think the real challenge is to align the trillions invested daily in capital markets with the SDG goals. This includes resources from institutional investors, banks, retail investors, as well as private philanthropy. Many sectors, public and private, actually have misaligned and even incompatible with the SDG in terms of their investments. And despite claims of focusing on social and environmental impacts, very few investors these days are transparent when it comes to monitoring and tracking their contributions. Many funds claim to be investing in SDGs, but do not release their data methodology, possibly due to commercial confidentiality. So what we're trying to do is, how can we close this gap And the most important thing is Hong Kong, as I said earlier, we have announced a standard for these to be disclosed by all relevant sectors. And whether you are financial institutions, asset managers, securities firms, listed companies, you will have to disclose where you are in terms of your ESG portfolios. So we are hoping that by driving this standard disclosure, we will see more transparently where the money is going, which will lead to more impact investments.
Thank you all very, very much. We are at the end of our session. I hope that everyone that listened in got a lot out of the concrete examples, understands sort of the transition that that's underway right now, and understands how these are examples of where the market is going, what you are going to see more of in the next 3 to 5 years. So thank you all very much to our wonderful speakers and to the audience. I just want to give a quick heads up. The next up on the program is a fireside chat with Carol Ann Hilton, CEO of Indigenomics Institute, and an inspiring voice who brings a fresh new look on the modern Indigenous economies and possibilities for the future. We've heard her speak, and her ideas are thought-provoking and offer lessons for all of us. You don't want to miss this. So I invite you all to return to the main webinar session. You will find the link to the main webinar in the chat box. And at any time, if you lost track of how to access the session, you can find the links in the Next Normal Now registration confirmation email. Thank you all so much, and have a wonderful rest of your day.
Thank you so much.